Hi everyone and welcome to today's morning report on Thursday 28th of April with me, Richard Perry, market analyst at Handset Markets. We've had so much going on overnight. We've had three central bank meeting decisions, none of which moved on interest rates, but we still had some incredible moves on the markets in reaction to that, because basically the Bank of Japan and the RBNZ, seemingly the market had been pushing towards some sort of action and didn't get it, so we had a strengthening, a significant strengthening of the yen and the Kiwi. Now, starting with the Fed, we had an announcement yesterday that of no interest rate move. Not really unexpected on that, but there was a slight tweaking of the Fed statement that sort of moves us towards the possibility of a June hike, and I don't think it's going to happen. But they've removed or certainly toned down the focus on the global economic conditions that have seemingly been preventing or prevented a hike in March. I sort of removed that from the statement, and that's sort of given a slightly hawkish move, but still, despite that, we saw the Treasury yields sharply lower. The 2-year Treasury yield falling away. Look at that, and also the 10-year as well. Now, I've got on the 10-year chart the meetings of September, December, and March, all of which resulted in sharp moves to the downside of these Treasury yields, and not. And lo and behold, we've seen moves to the downside again. So we still see these Treasury yields benefiting of, or certainly Treasuries and movements into Treasuries in the wake of these Fed meetings. So it's very interesting. Anyway, apart from that, we've had just general dollar weakness actually in the wake of this all these meetings, basically becoming because the BoJ didn't do anything with extending negative interest rates, as the market had been sort of led to believe, and also the RBNZ as well didn't cut rates. There was a possibility of an RBNZ rate cut, but that didn't come through, and also the committee sort of suggested that it was expecting possible strengthening of inflation as energy prices started to sort of normalise again. So it's driven a weaker dollar across the board, pretty much across the forex majors, and not only that, we've had on the net effect has been a big flight into safe haven assets, with gold strengthening, treasuries strengthening, and obviously the yen as well. So that has impacted across equity markets as well. Equity markets are lower today. And it seems as though sentiment is under pressure again. So the markets are continuing to react to this, and there's going to be a fair bit of volatility, I think, today as the markets sort of swing around and try and come up to to find their new levels. And we've got a bit of data out today, nothing too significant in the European morning. A bit of German inflation. First look at the German CPI, and then this is German inflation, expected to actually come down back to 0.1%, so just falling away on German inflation, and that has a read-through effect to the Eurozone inflation as well. So be careful for that. Then that's at 1 o'clock. Then at 1:30 we've got the advanced reading of US GDP. Now, US GDP came in, this is the advanced reading for last month, 0.7, but that subsequent revised higher to 1.4, but 0.7 is the expectation again today on an annualized basis. That's sort of middle of the road, really. It's not really a great deal of growth, and certainly in line with the Fed's sort of moderate comment for growth going forward. And then you've got the weekly jobless claims expected to come in at 258, so picking up off that low of 247. And also, interestingly enough, I think at 4 o'clock this afternoon, we've got the Kansas City Fed manufacturing data, which has been very negative recently. So watch out for that. That could have an impact on the dollar, certainly when the dollar has been so weak today. Now, my chart today is the FTSE. Now, I looked at the FTSE yesterday. I was going to sort of focus on the fact that we've had this where's the FTSE? There we go. Focus on the fact that we had this sort of breakout above 6237, then a correction back to it that was forming support, and it is still forming support above that breakout 6237. 6250 is the low in the last week or so, and I would say that is a buying opportunity. But we've had this sort of unwinding technical move today. The actual candle yesterday was a bullish engulfing pattern where we saw a move below the previous day's lows and a close above it. Actually, a close at the day high, that was a positive move. But we've seen, as I said, in reaction to this BoJ announcement or general loss of risk appetite, the FTSE has fallen away. It's now currently around about sort of 50, 60 ticks down on the day, which is certainly retracing much of the move. But at the moment, it's not broken yesterday's low, which is 6255, and also the support at 6250. So we're still sort of hanging on to this nice band of support, and it'll be interesting to see what happens now, because these momentum indicators sort of turned higher, but obviously are reacting to this initial candle lower on the hourly chart anyway. But need to form support above that 6250 to 6255 support that we've had in the last couple of days. We need to hold on to that to maintain this sort of what I see as this sort of bullish breakout, and I think it needs to sort of hold on to that to sort of continue to be seen as a sort of a correction that's been that's a chance to buy. Because you look at the the daily RSI, finding support at sort of around that 50 level is important. So it's currently at 51. So that's very interesting. Also, you've got the stochastics that are coming back to sort of a buying opportunity level around the 50 mark. So this is the point at which you would expect the bulls to remain supportive if you're going to see a continued upside. So it's a bit of a crossroads now for FTSE, I think, and holding on to that breakout above 6237 is important. So an important day ahead for FTSE. So I wish you good luck in your trading today, and I will speak to you later. Thank you.